Hello, everyone. Welcome to the RAISE seminar. I am Susana Talvaro, a research assistant at the Inter-American Development Bank. And on behalf of the RAISE team, I thank you all for joining us today. Today, we have Carlos Ballesteros, who is a PhD candidate in economics at Emory University, a research professor at Universidad de Afit in Colombia, and his research interests include international finance, financial frictions, and economic growth. Today, he will present his joint work with Alejandro Torres, Cesar Tamayo, and Santiago Novoa, titled Go Your Own Slope, Macroeconomic Effects of Basel III Liquidity Regulations in Emerging and Developed Economies. Carlos, thank you for sharing your work with us, and we hope that this session is very fruitful for you. The seminar dynamics is as follows. We have 40 minutes for the presentation. If you want, we can have clarifying questions during the presentation, and at the end, we will open a 10-minute space for Q&A. The floor is yours, Carlos. Thanks again.
Thank you, Susana, very much for having me in this seminar. This is the first time we are going to present officially our paper, and we have been working on it for more than 1 year, or probably more than 2 years. So yeah, I'm so glad to be here, and thank you for the invitation. All right, so here we have a pretty standard outline. So first, I will present you the introduction, the motivation and what we do. Then the empirical strategy and findings. Then we would like to understand what we get here through a macroeconomic model. Then I will present you the calibration. Then we will do some simulations in general and partial equilibrium, and we will analyze the results. And based on our work, we will do some conclusions and policy implications. Well, so basically, Basel III regulations have been intended to mitigate or soften private credit cycles, and to avoid bank risk-taking all over the world. So when we talk about Basel III regulations, we're talking about two main things. First, we talk about capital requirements. So capital requirements basically are intended for banks to keep a greater share of bank net worth in order to finance such entrepreneurial credit. And a second tool of regulation, we have the liquidity requirements. So basically, this requirement will consist that greater share of deposits in banks is kept so they can cover against a potential bank run or bankruptcy risk in general. So what we have observed in the literature is that capital requirements are found to lower credit and improve financial stability. However, the literature hasn't been that clear in terms of the effect of liquidity requirements, especially in emerging market economies. So to see that, you can see papers like Chadhan Corrado in 2012, Vasquez and Federico in 2015, Khan and Sadike in 2018, among others. So basically, a first question that we motivate here is what are the effects of liquidity requirements on private credit and financial stability? What about the macro? So that's a first point. Another concern that we have here is, okay, we know that these Basel III regulations have been set up and established for all over the world. So they have not distinguished between the effects between emerging and developed market economies. So basically, to see potential differences between these two geographies, we can see here in this graph the liquidity coverage ratio, or LCR, per country in 2018. So for the United States, for the USA, and some emerging market economies. So what we can observe is that in the case of the European Union and the USA, we can observe that the banks that have the minimum LCR in the whole country, In developed countries, they meet the 100% liquidity requirement. So basically, this LCR is intended, so with the policy, when we talk about greater share of deposits is kept by banks so they can cover against any, bad contingency. This regulation is intended for banks to get the 100%, the 100%, 100% of the deposits that are intended to be gotten out later. So what we see here is that banks in the developed market world, they don't struggle to meet this 100% LCR requirement. However, when we see the Latin American cases or the emerging market cases, we can observe that there is plenty of heterogeneity here. So we can observe that there are banks that meet by far the LCR requirement, right? However, in the other extreme, we have banks that by far don't meet the requirement. So there are banks in these countries that seriously struggle to meet the LCR requirement. So as this is the case, then there is another question that we wonder, which is that do liquidity requirements have the same effects in developed and emerging countries, given that these LCR requirements have been established uniformly all over the world? And then what about the world picture? So basically what we're going to do is to see a world picture, and then we are going to split the results into DM and EM. So given these two questions, one and two questions, then we can now motivate our research question or our main purpose here, which is to study the impact of Basel III liquidity regulations on private credit, financial stability, and the macroeconomy in both developed and emerging economies. Well, here we have some general results. So in summary, we can see that the world picture can be misleading because the empirical findings differ dramatically between emerging and developed market economies. So in particular, we see that an increase in the LCR measure, which represents here the Basel III liquidity requirement, lowers the private credit and financial system default probability in emerging markets. So basically, what the liquidity regulation is doing in emerging markets is to increase credit, but also is improving the financial stability. By contrast, an increase in the same LCR measure will increase the private credit in developed markets, while the financial system default probability is not affected, which means that financial stability will not be affected in developed market economies. Well, in order to understand these empirical findings, we basically take a Bernanke, Girdler, and Gilrich 1999 framework, and we extend it to include liquidity regulation in the spirit of the LCR. Also, we will assume, an additional asymmetric information, but this time is going to be between banks and depositors. And basically, by doing this, we get theoretical results that are consistent with our empirical findings. First, the LCR measure in less financial developed economies, and by less financial developed economies, we mean with high monitoring costs, then that will increase deposits costs more than in highly developed countries. And as a result, we will see that the credit supply curve is contracted in emerging markets, but the same curve will be expanded, shifted to the right in developed markets. So basically, that's the reason why we in the data observe in equilibrium lower private credit in emerging markets and higher credit in developed markets. Not only that, but also in general equilibrium, we see that this lower credit in emerging markets will lower entrepreneurial leverage in emerging markets, which in turn decreases financial system default probability, which in turn improves financial stability. And finally, regarding developed markets, there we observe in the theoretical model that the lower monitoring costs, or in other words, being highly financial developed, will make the increase in the LCR measure will lead to a lower response of interest rates in developed markets compared to emerging markets. And this in turn will make financial system default probability almost unresponsive to this Basel III policy, liquidity policy. And that's basically what we do here. Okay. Well, this is our empirical model. So here we will have annual country level panel data from 1999 to 2017 for 3 geographies in particular. First, emerging market economies. So we consider 66 countries. Then developed market economies with 34 countries, and the world, which is nothing but the summation, just including all the sample there in our regressions. Well, our LCR measure is going to be liquid assets to deposits and short-term funding. And this variable is expressed as a percentage. And we take that from the World Bank Global Financial Indicators database. And this will be specified, this variable, in country I in year T. So we are going to denote that variable by this notation. And our credit measure is going to be the domestic credit to private sector as a percentage of GDP. And again, we can find that in the World Bank Global Financial Indicators in country I in year T. And this is how we're going to denote that variable. And if the variables will be expressed in terms of the first difference in order to avoid any kind of non-stationarity. Well, since we would like to measure the impact of the LCR measure on credit and financial stability, then here we have 2 regressions. So first, we would like to quantify the impact of the LCR measure on credit. So here we have credit as the dependent variable as function of its lags, function of the measure we are interested in. And here we have an interaction term that will be key, especially for emerging market economies. Here we will have the interaction between the liquidity ratio measure, times the an indicator of financial development that is going to be gotten from the IMF financial indicator database. So basically, this interaction is going to be very important. And then, otherwise, we're going to have control variables that control for country-specific characteristics. And here we have country-specific fixed effects and annual time fixed effects. Also, we would like to estimate the effect of liquidity measures on financial stability. Here we are going to proxy financial stability with the change in the natural logarithm of the z-score in country year T. And this is going to be a function of credit lags, the lags of the same variable, z-score, plus the same regressors that we have here in the first regression. If you have any questions, oh, thank you, Susie. Yeah. Well, how to understand this financial indicator variable from the IMF? So basically, I have here a screenshot of the IMF Financial Development Index webpage. So basically, the financial indicator that summarizes everything is FD, or financial development. In turn, this is constructed, or a compound between these two, between financial institutions, FI, and financial markets, FM. And in turn, the development of financial institutions and financial markets is a compound of 3 main indicators, which is how deep are the financial institutions, how easy is to get access to the financial system, and how efficient these financial institutions work. So this map is important for our empirical results later on. Well, here we have the empirical results. So first, private credit in the world. So what we have here is, our dependent variable, credit over GDP. And then its lag is statistically significant and positive. This makes sense. The liquidity ratio, the main variable we are interested in, has a positive and statistically significant effect on global credit. And here we have some controls. Here we have liquidity liabilities over GDP. It has a positive and strong effect on private credit in the world. And we have the capital ratio, because we also would like to control for capital ratio, since the literature says that it has an important effect on credit, both in credit and financial stability. So capital ratio has a negative effect on world private credit, which is striking. Why? Because the liquidity ratio has a positive effect and the capital ratio has a negative one. So a good thing of this capital ratio having a negative effect is that this is consistent with the existing literature that evaluates the effects of capital ratio on credit. And here we have that a bank crisis will diminish credit. Makes sense. And then we have some interactions terms here. That is the reason why we have here several models. So first, we would like to check whether higher financial development affect credit. Indeed, it has a positive and significant effect. However, when we introduce this interaction between financial development and liquidity ratio, then okay, here is not still significant. It will be significant later. So here, in terms of credit, this financial development is important. But okay, this influence from financial development comes from financial markets, more developed financial markets, or more developed financial institutions. Well, basically, is this influence is coming from here or from here. So basically, when we put the FM financial markets, there's nothing significant. But instead, when we include the financial institutions, then we have a positive and strong effect. So basically, the effect from more developed financial sector towards credit is working more through more developed financial institutions.
Sorry, Carlos, can I ask you something?
Sure, yeah.
The variables FM and FI and FD, are they dummies? I don't understand.
No, they are indices.
Okay. Okay, thank you.
Of course.
Salim also has a question.
Thank you. Just one question. Where is Basel here, or what's where do we see that in the regression?
Oh yeah, it's here. Is this one, liquidity ratio? I should have put this like LCR, right? Should I change? Probably I should change this liquidity ratio for LCR. I mean the notation.
Okay, so the question is maybe, so the liquidity ratio could be important with Basel or without Basel. So like a country could, like, that's an important ratio, even if there's no regulation, right?
Right.
So question is, whether do you control where your countries are, like if the ratio is satisfied? Yeah. Okay. Sorry. Go ahead.
Yeah. I think I got you. So we control for that. You know, we incorporated that first in one of our trials. We included a dummy which said, okay, is equal to 1 if the country adopted the regulation, other than not. But turns out that the effects are not statistically significant, and probably is because the regulation will take place completely after 2019. So it was the LCR requirement was like 60% in 2015, then it increased to 70% in 2016, and so on until reaching 100% from 2019 onwards. So basically, this work is telling that, okay, we haven't seen the LCR requirement completely, you know, taking place. However, we can observe through time a reliable measure of LCR that will tell us whether we should expect certain movement in credit or in financial stability, say in 2021, 22, 23, when enough time has passed after the policy has been enforced. So this is something, this exercises is something like, okay, what to expect once we are in the middle of the party of the LCR enforcement.
Got it. Thank you.
Yes, of course, Salim. And we have another question from Andrew Powell.
Yeah, can you hear me? It was kind of the same question really as Salim. I mean, I think most developing countries, you'll find that the banks just naturally we want to have a lot of liquidity. I mean, much more liquidity. So the more the institutionally weak the country, the more volatile the country, the more liquidity banks will want to hold, right? So, but it's pretty difficult. It's an endogenous variable, so it's pretty difficult to understand, quite frankly, how to interpret your regression.
Yeah. So yeah,
when you talk about LCR, the actual Basel regulation, I mean, it depends how it's implemented, because it may not be binding at all, or it may be, depending on how it's actually implemented. So it's hard to come up with predictions about what the introduction of the regulation would entail.
Yeah, I agree with you. We when we were doing these regressions, basically we thought that, or we hypothesized probably what you meant in your first question, which is there are reasons to expect that actually credit influence liquidity, the liquidity levels of an economy, or backwards. So there is like an endogeneity that makes not clear whether the effect goes from the LCR measure towards credit or the other way around. So in order to make sure that we are in the correct track, then we made what we made was a Granger causality test, saying that okay, the lags of the LCR will affect current credit, or the lags of credit will affect current levels of LCR, and all the results for EM, DM, and the world, the results indicate that the causation Granger sense goes from LCR towards credit and not the other way around. So we dealt with that concern already. However, we are not sure whether we dealt correctly with that, because we are talking about Granger. We're talking about causality in the Granger sense, but given the Granger, I mean, we performed the tool that is available, that is currently available, and then we said, okay, LCR causes credit in the Granger sense, but not the other way around. So that's why we went on by this kind of a specification, in the sense that the liquidity would affect credit and not the other way around. And the second question, yeah, is very hard to measure the LCR, because you can have several measures of liquidity. So we basically went with this definition: liquid assets, deposits, and short-term funding, because basically the LCR what tells is, okay, in the numerator you have high quality liquid assets, which is pretty much or similar to this to what we have here in the numerator, and then the denominator is basically a percentage of what the financial, or a percentage of what the banks are expecting to be withdrawn from the public, yeah, in the next 30 days or in the next short term. So basically we said, okay, this LCR measure, that is basically this variable that is in the World Bank, we saw that it can be similar enough to the actual definition of what the LCR is. But other thing that we liked a lot about this measure is that it's the same measure for all the world. It's a standardized measure. So you don't have to deal with that in this country, LCR was measured in some way, and then in this other country, the LCR measure was measured in another different way. So with this standardized way to measure the LCR, we ended up being happy. But of course, we are open to other kind of interpretations, or if there are better measures for the LCR measure, we will be open to that. Yeah. Thank you, Andrew, for your question. All right. Yeah. So this is for the world, and now for developed markets. So for developed markets, we have pretty much the same picture as in the world, but we have here the effect of the LCR measure on DM credit is positive and statistically significant, and is stronger, significantly speaking, with respect to the world, but also in absolute value, the coefficient is bigger. The capital ratio has a negative impact, and the interactions between the LCR measure and the financial development are not significant, as is the case in the world. And here we have a striking different result for private credit in emerging markets, which is that here we have a positive coefficient for developed, and for emerging, here we have a negative coefficient, which is even more significant than the other one, because this is at 5%. Yeah, but for emerging, this is at 1%, and is negative. Now the capital ratio is negative. The effect is negative, but is less significant. And yeah, that's basically what I have to say here. And what about the bank CS score, which is our proxy for financial stability? So here we can observe that the liquidity ratio has no significant effect for the world, but the capital ratio has a strong and positive effect on world financial stability. So the capital ratio effects on both credit and financial stability are in line with the literature, in the sense that the capital ratio lowers credit and improves financial stability. Yeah, and none of the interaction variables are significant. Pretty much the same for the world, for developed markets. So here you have no significant effect, and none of the interactions are significant. But here for the emerging markets, you have that the LCR measure has a negative and strong significant effect on financial stability. However, this means that in principle, this liquidity ratio, or the unconditional effect, is negative on financial stability, and capital ratio, its effect is strongly positive. However, what about the interaction variables? So here we have that the unconditional effect of the financial development has a positive effect on financial stability. However, the interaction between the LCR measure and the financial development indicator, that effect is very high. You know, is very high and is strongly significant. So basically, conditional to having a higher financial development, then we read this coefficient as that an increase in the liquidity ratio will end up improving financial stability in emerging market economies. So here we have two opposite forces. One the unconditional force, which is negative which is diminishing the financial stability, and we have another compensating force, increasing financial stability, but as long as the financial system is developed enough. Well, and again, which financial indicator is influencing the most to this financial development indicator? So we did exactly the same with financial development, financial markets development, and we don't have any significant effect. But when we do the same with financial institutions development, then here we have the effect. So here we have a positive and strong effect of the financial institution indicator, and the interaction is also positive and huge. And in turn, this financial indicator can be decomposed into these three categories. How deep are working these financial institutions? How is the access to financial services, and how efficient are these financial institutions working? So basically, the result is that it's working through a more efficient functioning of financial institutions. So basically, we do exactly the same as we did here, but here with the sub indices. And then the indicator of financial access, not significant. Same thing with the deep. How deep is the system? But when we incorporate the financial institutions efficiency indicator, then it resembles what we saw here with the more global financial development indicators. So basically, the effect in emerging markets in financial stability is working through more through institutions that are working in a more efficient way. And here we have the empirical findings. So, like as a summary, what we see in the world is a dominance of the developed market economies in the world estimates. However, results for emerging markets and developed markets are striking different, as we just saw. We can see that the value and significance of the work coefficients are exactly in the middle of what we see in DM and EM's coefficients. In particular, for DM, we see that a higher LCR measure will increase private credit with no effect on financial stability. And for EM, we have that higher LCR measure with lower private credit, in principle, with deteriorate financial stability. However, when we examine the interaction between the LCR measure and a more financial and the financial development indicator, we see that the LCR ends up improving the financial stability in the emerging market economies, conditional on banks working in an efficient way. Well, how to understand that? Well, here we take the Bernanke, Gerler, and Gerrich BGG framework, and here we assume an additional information problem, which will consist between depositors and banks. Also, we will implement a regulatory authority in the model through a policy, a regulatory policy. And we will assume no nominal rigidities because our interest is not on the effects of monetary policy. And how this LCR policy will work in the model. So basically, specifically, a fraction of each unit of deposits demanded will be maintained by bankers in order to face, a potential bank run. And the adoption of this LCR policy will increase the cost of the deposits. So once the cost of the deposits is increased, then this will have consequences in terms of credit, financial stability, and the macroeconomy in general. Well, this is how the model works. So here we have a contract as in the fashion of BGG. So here we have households, bankers, and entrepreneurs. So here we have basically what you see in the BGG is asymmetric information between bankers and entrepreneurs. But here, the additional thing that we embed here is additional asymmetry of information between households and bankers. When households will interact with bankers in a deposits markets. So household offer deposits, bankers demand deposits. So from here, we will get an equilibrium deposits interest rates in quantities of deposits. And in turn, bankers will relate with entrepreneurs in a credit market. Bankers supply credit to entrepreneurs demand credit from banks. And then here we will have an equilibrium interest rate of credits and equilibrium quantity of credit. This is the contract. Now, what happened in general equilibrium is pretty straightforward and typical. So basically, bankers they will consume goods in the goods market. They will supply labor in the labor market, sorry, in the labor market. Now, entrepreneurs will supply goods and services in the goods market. They will demand labor in the labor market. And households will demand goods and services in the goods market, and they will supply labor in the labor market. And finally, here we have the liquidity regulation that will be imposed on bankers. This is the model. So as in BGG, basically the capital that entrepreneur needs, basically capital times price of capital, will be equal to entrepreneurial net worth plus credit. And this credit is going to be built by banks by using bank net worth and deposits from the public. And then the liquidity regulation will enter here in a very simple way. So basically, the credit is going to be equal to bank net worth plus a fraction of the deposits, because the tau fraction is going to be, kept safe by banks in order to cover against any potential bank run possibility. Well, let's see what I said. All right, so basically what we have is, here is the gross income that the entrepreneur receive for using capital. So here we have that this is what the entrepreneur produces. Basically, the capital, the value of capital times the return of the industry. So basically, this is a general observable interest rate. This is aggregate price, right? Times a random productivity idiosyncratic shock that every firm faces. And this omega will follow a log normal distribution. We will have a cumulative distribution, uppercase f of omega, a marginal distribution function, lowercase f of omega. Well, there will be a minimum value of omega, like omega bar, which will be the minimum required productivity level for this entrepreneur to be able to pay back the loan to the bank. So here we have the omega times what this entrepreneur produces will be equal to the loan or that needs to be paid back to the bank times the interest rates that the bank basically asked the entrepreneur to pay back for. Well, what are the dynamics of omega? So if omega is higher than omega bar, then entrepreneurs will pay back their credits to banks with no problem. But omega, for some reason, can lie below. This is if omega is lower than omega bar, this is omega bar, so this is a typo, then the entrepreneur have not enough resources to honor that. So basically, entrepreneurs will bankrupt, but still the banks can go and take the leftover by the entrepreneur, and then there will be an auditing cost or monitoring cost, which in case of entrepreneur bankruptcy, then with this cost faced by the bank will take the leftover by the entrepreneur, and then this will be the what the bank will take, right? The net of this cost. But if entrepreneurs go bankrupt, household doubt about the ability that banks have to pay for their deposits, right? So in that case, omega can be higher than something that we call omega star. So omega star is the minimum productivity requirement that the bank has to have in order to be able to pay back the deposits to the depositors, to the public. So omega can be lower than omega bar, but still can be higher than omega star. So in that case, the banks can still pay back the deposits to the depositors. And then in that case, the household receive this, right, this amount. But turns out that omega can be very low, even lower than omega star. So in that case, banks go bankrupt. And in that case, households need to face a monitoring cost and take what's left over in the bank, right? Then that that monitoring cost is going to be omega. So I put these monitoring costs, mu and gamma, in colors because they are going to be key for our results. So basically, so I think we don't need this math. So here is the contract. So basically the optimal contract is designed by the bank such that the entrepreneur can maximize its profits, subject to that the possibility to that the bank will participate in this business, and also the depositor is going to participate in this business. All right. So basically, from this contract, the choice variables are going to be omega star, omega bar, and the level of capital, which in turn will give us the level of optimal credit from this contract. And from this contract, we have, I would say, the two most important equations of this model. So basically, here we have the deposit supply curve, which is nothing but basically the process that the deposit's interest rate follows. So here, deposit's interest rate is going to be equal to the risk-free rate plus a bankruptcy risk or external finance premium, right? So basically, the higher the debt of the bank with depositors, the higher this risk premium will be. And importantly, note that this external finance premium is going to be importantly affected by gamma and mu, the monitoring costs. And in addition to that, here we have the credit supply curve, which will be also important. You will see why. And this is nothing but the description of the process of the capital interest or of the credit interest rate, which is RK. So RK is equal to, again, the risk-free rate plus an entrepreneur's bankruptcy risk premium or spread, right? So again, the higher the debt or the credit has the entrepreneur with the bank, the higher this premium, right? And importantly, monitoring costs affect, importantly, this external finance premium. Well, this is the standard calibration. Basically, here we have monitoring costs for banks mu equal to 0.38. This was taken from Fernandez and Gulan. And monitoring costs for households gamma is going to be equal to 0.54, taken from Badarawa and Popescu. So this is the calibration for a representative emerging market economy. So what we are going to do is to work with this calibration, representing the emerging market economies. And later on, what we are going to do to represent the developed market economies is to let everything equal, but to lower this mu and this gamma. Well, this is the general equilibrium simulation, the results. So basically, with a tighter liquidity regulation, then using deposits will be more expensive because there is a higher scarcity of deposits, relative scarcity of deposits now in comparison to before, right? Therefore, as a result, the interest rate will increase, right? So here we have the credit interest rate increases, also the deposits interest rate increases. And as a result, credit and deposits will go down, right? Now, as credit is lower in emerging markets, then you will have entrepreneurial leverage decreasing, right? And once you have entrepreneurial leverage decreasing, then you will have lower default probabilities in general. So you will have an improved financial stability. What happened with developed markets? So here we can lower monitoring costs, mu and gamma. And therefore, just by lowering mu and gamma and increasing the LCR measure by the same amount, then using for some reason that we will see later, using deposits is now cheaper. So interest rates decrease, right? Both. So both credit and deposits go up, right? Now, with higher credit, in general equilibrium, both entrepreneurial and banking net worth will increase more than proportionally So in general equilibrium, we will see a decreasing leverage for banks and entrepreneurs, which in turn decreases the default probabilities of the financial system. So again, we have an improved, we have a higher financial stability here with higher credit and deposits. So sorry, I come back here one slide to emerging markets. So here the lower credit and deposits in general equilibrium make aggregate investment, capital, and outputs to be lower. And the higher credit and deposits in developed markets will make in the aggregate to increase investment, capital, and output. Well, what's behind? We can go for a partial equilibrium explanation, because what we have seen is only general equilibrium simulation, but there is many things in general equilibrium, so we cannot do ceteris paribus analysis. So let's see what does the partial equilibrium tell us about this results. So suppose that we have high monitoring costs, and then we will be in emerging markets, right? Because with high monitoring costs, then we have a financial system that is less developed, and that's expected in emerging markets, right? So basically, here we have the credit market. So the regulation will make like deposits more desirable. There is a relative scarcity now of deposits, but turned out that the supply curve of deposits stays the same, because basically this supply comes from the depositors, right? But depositors don't feel the regulation, so the supply curve must be the same, right? So basically, what we observe with higher liquidity regulation is that these more scarce deposits can be represented by a shift to the right of the demand for deposits from the banks. So basically, the question is, okay, the cost of deposits makes sense that they will be higher, but then the question is how much higher they will be. Well, it depends on the slope of the deposit supply curve. So basically, if you have high monitoring costs, then you will have a much steeper supply curve, which in equilibrium will increase the deposit costs much more than the increase in deposits in equilibrium. So this huge increase in deposit costs will make effects in the credit market. This is the deposits market. This is the credit market. So in this credit market, the higher costs of deposits translates in higher costs of loans, higher costs to loans, to get loans, and basically we will have like more costly loans for the same supply amount of credit. So basically, what this does is to contract to the left the credit supply curve from the banks, given the same demand of credit from the entrepreneurs. So in equilibrium, this shift, this contraction of credit supply will in equilibrium increase credit interest rates and will contract credit in equilibrium. Well, what would happen what happens in developed markets? So we can suppose monitoring costs, low enough, so that in equilibrium, the same shift to the right of the demand curve for deposits, but given a much flatter deposits curve, will increase in equilibrium the deposits interest rate, but very little in comparison to the huge increase in equilibrium deposits. So basically we have more availability of resources of deposits, more financing. So that higher financing will basically will basically expand credit supply, and therefore instead of contracting credit supply, we will have an expansion of credit supply. And as a result, we will have lower credit interest rates with higher credit in equilibrium. So what I want you to be aware of here is that we have two different responses of credit in emerging markets. we have lower credit in equilibrium, but in developed markets, we have higher credit in equilibrium. All right, go euro slope. So basically what we have seen is that the effects of the LCR regulation on credit and interest rates depend crucially on the slopes of both deposit and credit supply curves, right? Which in turn depends importantly on the monitoring costs. So basically what we have seen is that these movements, both in general equilibrium and in partial equilibrium, are consistent with what we found in the empirical evidence. So basically, if you would like to understand the effects of the liquidity regulation on credit and financial stability, and then on the macroeconomy, you need to go your own slope. I mean, you need to be aware of how financially developed is your country in order to expect one result or another different result. Well, in terms of conclusions and policy implications, basically, we have challenged two existing ideas about Basel III liquidity requirements. First is that in terms of liquidity requirements, in the literature, there is a lack of consensus about the effects of Basel III liquidity regulations on credit and financial stability, and that Basel III regulations, I mean, initially are thought to operate equally in emerging and developed markets. But what our research finds, just a second, please. Basically, our research finds that the LCR measure has statistically important effects on credit and financial stability that can be explained in principle from extended BGG framework, and that also we learned that the results in the world whole picture can be misleading in the sense that if we split the results into emerging and developed markets, the results will vary dramatically. So we have different questions here, right? Questions?
Yeah, thank you very much, Carlos, for your presentation. So we have questions from Andrew Powell. So the floor is yours.
Thanks. Carlos, just two points if I can. So, I mean, first, I think it would be important theoretically to sort of determine what the externality is that the regulation is trying to correct. So banks, of course, don't want depositors to run on themselves. So they will by themselves hold liquidity to, reduce the probability of a bank run or something like that. So you need, theoretically, you need something which says, well, there's some failure there, right? That, the usual thing is that banks don't protect, that they, there's a difference between their private cost and the social cost of a bank run. That could be one. Or that the central bank or somebody is providing insurance. And so, there's essentially a moral hazard. So to protect the moral hazard, you need some regulation. But you need one of the two normally to, justify the regulation. So that's the first point. On the second point, I mean, I think the monitoring cost is really interesting. Of course, and there's another difference between developed economies and many developing economies, which is how liquidity regulations are actually implemented. So, typically, and I'm talking sort of a bit broadly and superficially here, but many developing countries maintain high reserve requirements or encajes, in central banks. And that's actually the main form of liquidity regulation in many, many countries. Whereas in many developed countries, the reserve requirements are extremely low. And so according to Basel, banking, liquidity is essentially held on the bank balance sheet, but not at the central bank. So actually, I wrote a proposal once, which was to implement the Basel liquidity regulations, but through the medium of the central bank, or some central custodian, precisely to reduce the monitoring costs. So because of course, if the liquidity is held in the central bank, you could argue that the monitoring costs are less. So it might be interesting to think about the differences between how liquidity is regulated and where it's held in developing and advanced economies in relation to your monitoring costs. I think that could be quite an interesting avenue of research.
Definitely.
To see how it would fit in the model.
Yes, because yeah, I agree with you a lot, because in our model, I mean, we are imposing this policy here. Yeah, that's a great point. Was it? I think it was here. It was here, yeah. So basically, we impose this constraint in equation 3, but as you say, in the model we don't have how are what are these banks doing with this money, right? With this health money. The only thing that we do is that, okay, in the contract, these banks are basically, these banks, not only banks but also depositors, they have this restriction that you know, their expected profits, respectively speaking, must be higher than or equal to their opportunity cost, and here we have the risk-free rate. But other than that, we actually don't have how to. We actually don't have modeled what these banks are doing with these extra levels of liquidity, especially in emerging markets where we see some banks with huge level of liquidity reserves. Yeah, I think we should think a little bit on that for our model. Yeah, thank you for that suggestion.
Thank you very much. Does anyone else has a question or a remark? I guess no. So thank you very much, everyone, for joining us today. We will meet you in 8 days next week. So thank you very much, Carlos, for your presentation, and have a good week.
Thank you very much. Thank you for inviting me, and have a week, a good week too.
I'll remember this session was recorded, and we will have it on our YouTube channel.